Here we have a case. Your company needs to purchase a high-tech oven for $131,000. You have two ways to pay for it, and you need to decide which is the most cost-effective for the business. Option A, bank loan. Finance the full $131,000 through a bank at a 7.2% interest rate. Option B, cash. You have the cash. Pay $131,000 using the company's savings account. Currently, that account earns 4.5% interest. So now, here it is also talking about opportunity cost. Because if you pay everything out of your pocket, that $131,000, you don't receive this 4.5% interest anymore. Okay, it says analyze the case under different tax rates of 10%, 20%, 30%, 40, 50, 60, and 70%. So let's do it as an activity together. For the first part, as activity 1, give your analysis on the case while the company pays no tax on the interest they are receiving on the saving account. Because here they receive 4.5%, and we all know that absolutely it's a taxable income. But for the sake of simplicity, and the fact that we are gonna make the case step by step more complicated, more sophisticated, so let's start activity 1 with this assumption that the company doesn't pay any tax on the interest they are receiving. Okay, so what you should do, you should start your analysis, and it is just an activity as a practice on the things that we are doing together, we are learning together. Do that comparison under different tax rates, that which one is better, which option is better, option A or option B. Do not overcomplicate it. It is just combination of tax and savings the tax bring you, that tax shield or that type of thing. So stop the video and start doing the analysis, because immediately I will go to the answer and discussion. Stop the video now. Here is a simple analysis. We have all the tax rates here, 10%, 20, 30. And here we have our two options. Option 1, that is loaning, getting the loan, and option 2 was using your own cash, but it comes at a cost that you lose this interest rate. So now we are comparing everything. So since now the interest rate on the loan that you are paying is 7.2%, so it seems you are paying more money than you receive. But somebody comes and say, no, you are gonna also save on the tax, because 10% of this save you the tax. So the real interest rate if the tax rate is 10%, is 6.48%. And you continue this calculation, and I hope you have come up with the same answers, and now you are just checking. Based on the tax rate, your saving would be different, and it makes sense because it is tax related saving. And more you pay interest, more you save. See, more you pay interest, more you have tax saving. So that's the reason more tax rate, you see the real interest rate would be lower, because this 7.2 is the amount of interest you are paying, and you don't need to pay tax on that part. And what is the rate of tax, for example, here? 30%. So 7.2, 30% discount, 30% shield. So 7.2 times 0.70%, 5.04. So if we consider these two as rational rates for the interest, because these ones are magnified, exaggerated, just to show you different cases, just to show you the effect of savings that comes with tax. But here you have 7.2 and the tax rate is 30, so you need to times it by 0.7 and you get 5.04%. But if we go for this, so you are gonna pay 5.04%, and for this one, even if they didn't charge you on tax for the interest you are receiving, because it's the income you have, you are getting, for example, from a certificate of deposit, okay, still you are paying more. So it would be better just pay it out of pocket. So it gives you a point. It is not always let's go for the getting the loan because it saves us money when you have the money. So that's the reason many people prefer paying cash, because they said that I have the cash, and for the cash I'm getting only 4.4% that I need to pay tax on that again. Why I should finance something at 7.2% that even after tax deduction still it is higher than the interest I'm receiving? I hope now you are getting the insight here. But it is when the opportunity cost it only and only money. But sometimes you want to have the cash for some emergency costs or that type of thing that we are not considering them here. So if the tax rate is 40%, the real interest you are paying is 4.32. That is lower. And here now you are seeing, if the tax rate is 10%, pay cash. If it is 20%, pay cash, because the discount you are receiving, the shield you are receiving because of the tax is not big enough. And here we have 30%, again cash, and after that it says that no, go for the loan, because the loan nominally is 7.2%, but in reality it is way lower than that. Okay, now let's go and do activity 2 together. For the activity 2, let's do it in this situation that you pay tax on the interest you are receiving and see what you get. Stop the video and do it on your own. Activity 2, while we have also paying tax on the interest rate. And remember, now we are comparing two options that we have. One option is getting a loan at 7.2%, but since it brings us tax shield, it may always we think that that's the better option, and it's better we can keep our money in our saving account and getting interest from that. And here, when the situation gets more realistic, that if the interest you are paying to the bank provide you shield based on the tax rate, but remember, exactly the same tax rate applies to your interest revenue. So if the saving account paying you 4.5% at the situation that the tax rate is 10%, in fact you are receiving 4.05%. If the tax rate is 30%, you are not receiving 4.5%. You are in fact receiving just 70% of that, because you will pay tax for that 30%. So you are receiving 3.15%. So as you can see, if you go and finance the project with that 7.2%, and we are happy that, oh, we are going to get tax shield. Okay, so it makes that 7.2% 6.48%. So it means that you are still paying something, but not as much as before tax. So I'm just trying to give you that idea that it's absolutely misunderstanding that you think that whenever you go, when you have the money, because we are going to also check the other cases that you don't have the money and now you are thinking about loaning, getting loan or getting partner. That's another story. But now we are comparing the cases that you have the money. When you have the money, the opportunity cost of doing your business in cash is the interest you are losing. But the interest you are losing, you should apply tax impact on that as well. So as you can see, the same tax rate that applies to your interest paying applies to the interest you are receiving. And as you can see, the cost of getting the loan even after tax shield, tax reduction, is always higher than the opportunity cost of cash. Because when you pay in cash, you lose 4.05%. When you lose cash, and when the interest rate, when the tax is 30%, you lose 3.15%. That's the opportunity cost of paying in cash. But remember, with the same tax rate, if you go and get the loan, you are paying 5.04%. That is obviously higher than the opportunity cost of 3.15%. And it is solid, when this analysis is solid, that you have no plan for your money and you just want to put it in an account to take interest on that. If that's the only way you are looking at it, you see, it is not a wise decision. Yes, if the interest rate of the bank is something like 3.25%, and the interest rate you are getting from your certificate of deposit is, for example, 8%, yeah, it is worth it. Just keep the money and go for the loan. But if you just put the money with these rates, and in the scenario that we just did together, you as the financial manager should be more aware of the situation. But it's possible that they say that we want to keep that $131,000 in the bank, and this interest that we are getting is the secondary objective of us, goal of us for keeping this money. We are keeping this 131 because we are doing some investment, short investment, in buying and selling something. Or with this 131%, we are also funding another business that can happen, that can come up from time to time. So they have planned for this 131%. Or they may say that very soon in future, we sure the bank, because of anything, we cannot get any more loan from the bank, and it is the last situation that we have for this 7.2, so let's go for that and use this 131% next year for expanding on our operations more. So the interest they are receiving is not the solely, it's not the top target reason they are holding the cash. They have some plans for this 131,000.